Welcome back to our Foundation to Accounting course. In the previous lesson, we learned about the accounting cycle. Now, we are moving into phase 2 of the course, where we move from theory to practice. The first practical question we must answer is, what is a business transaction? Accounting begins with transactions, and if you cannot identify a transaction, you cannot record it properly. In the previous lesson, we learned that accounting follows a clear journey: transaction, journal, ledger, trial balance, adjustments, and financial statements. This lesson begins phase 2 of the course. Before you prepare journal entries, post to ledgers, prepare a trial balance, or prepare financial statements, you must first know what should be recorded. The core idea is that not every business activity is an accounting transaction. Only events that affect money, assets, liabilities, equity, income, or expenses should be recorded. Many business activities are not transactions yet. Many beginners think every business activity is a transaction. That is not true. Discussing a possible sale, receiving an inquiry, planning to buy equipment, or receiving a price quotation may be important, but it is not yet an accounting transaction. Selling goods, buying equipment, paying rent, receiving cash, borrowing money, and owing a supplier are accounting transactions because they affect the business financially. By the end of this lesson, you should understand what a business transaction means, what qualifies as a transaction, what does not qualify as a transaction, the importance of source documents, the difference between cash and credit transactions, and examples of transactions from real businesses. Why this lesson matters for students? If you are a student, this lesson is important because transaction identification is the beginning of accounting. Many students struggle with journal entries because they rush straight into debit and credit without first understanding what actually happened. This lesson will help you identify transactions correctly, understand source documents, separate business activities from accounting transactions, analyze questions more carefully, prepare better journal entries, avoid classification mistakes, and build confidence. If you are a business owner, this lesson is important because your financial records depend on how well your transactions are captured. You buy stock, sell products, pay workers, pay rent, receive money from customers, owe suppliers, receive debts from customers, invest money, and withdraw money. If these activities are not recorded properly, your financial reports will not show the true condition of your business. This lesson helps you reduce confusion, missing records, and poor decision making. Now let's get into it. What is a business transaction? A business transaction is an economic event that affects the financial position of a business and can be measured in money. In simple terms, a business transaction is any activity that changes what the business owns, what it owes, what the owner has invested, what the business earns, or what the business spends. Examples of transactions include buying goods, selling goods, paying rent, receiving cash, borrowing money, buying equipment, paying salaries, receiving a customer payment, buying supplies on credit, paying a supplier, owner investing capital, and owner withdrawing cash. All these affect the financial records of the business. What qualifies as a transaction? For an event to qualify as an accounting transaction, it must normally satisfy three conditions. First, it must affect the business financially. Second, it must be measurable in money. Third, there should be evidence or support, such as a receipt, invoice, contract, bank statement, payment voucher, or similar document. If the answers are yes, it is likely a business transaction. Condition 1. It must affect the business financially. The first condition is that the event must have a financial effect on the business. If a business pays 1,000 Ghana cedis for rent, cash reduces and rent expense increases. That affects the business financially. If a business sells goods for 5,000 Ghana cedis, revenue increases and either cash or receivables increase. But if the owner simply thinks about expanding next year, there is no financial effect yet, so it is not a transaction. Condition 2. It must be measurable in money. The second condition is that the event must be measurable in money. Accounting records transactions in monetary terms. Buying equipment for 8,000 Ghana cedis is measurable. Paying salaries of 3,000 Ghana cedis is measurable. Selling goods for 2,500 Ghana cedis is measurable. Improving customer service reputation may be valuable, but it is not usually recorded unless it can be measured reliably in money and relates to an actual financial event. Condition 3. There must be evidence or support. The third condition is that a transaction should be supported by evidence. This evidence may be a receipt, invoice, contract, bank statement, payment voucher, sales order, or another document. Accounting should not be based only on memory. Evidence helps prove that the transaction happened and helps accountants record the correct date, amount, and description. What does not qualify as a transaction? Not every business activity is an accounting transaction. A customer asking about prices is not yet a transaction because no sale has happened. Planning to buy a laptop next month is not a transaction because nothing has been purchased and no liability exists. Interviewing someone is not yet a transaction, although salary becomes a transaction when the employee earns it. A supplier quotation is not a transaction by itself. A document alone does not always mean a transaction has occurred. Why transaction identification matters? Transaction identification matters because everything in accounting depends on it. If you record something that is not a transaction, your records may be wrong. If you fail to record something that is a transaction, your records will also be wrong. A credit sale not recorded will understate revenue and omit accounts receivable. An unpaid electricity bill ignored will understate expenses and liabilities. Owner personal spending from business cash must be recorded properly, or their records may become misleading. Let us now look at source documents, the evidence behind transactions. A source document is the original document that provides evidence that a transaction happened. Common source documents include receipts, invoices, contracts, bank statements, purchase vouchers, purchase orders, sales orders, credit notes, debit notes, payroll records, delivery notes, and deposit slips. These documents help show what happened, when it happened, how much was involved, who was involved, whether it was paid immediately or on credit, and which account may be affected. Receipts and invoices. A receipt is evidence that payment has been made or received. If a customer buys goods and pays cash, the receipt shows the sale and the payment. If a business pays for fuel, the fuel receipt supports the expense. An invoice is a document issued when goods or services are sold, often showing the amount due. A sales invoice is issued to a customer, while a purchase invoice is received from a supplier. Invoices are very important for credit transactions. Other important source documents. Contracts may support rent agreements, service agreements, loan agreements, construction projects, or long-term supply arrangements. Bank statements show money coming in and going out of a bank account. They are useful for reconciling accounting records with actual bank activity. Payment vouchers are internal documents used to approve and support payments. They help strengthen control over cash and bank payments. Why source documents matter? Source documents are important because they create accountability. Without source documents, accounting becomes guesswork. A business may forget amounts, confuse dates, misclassify transactions, or lose track of customer and supplier balances. Source documents support accurate recording, reduce fraud and errors, help during audits, support tax filing, help resolve disputes, and help business owners verify payments and receipts. Cash transactions. A cash transaction is a transaction where payment is made or received immediately. This does not only mean physical cash. It may include mobile money, bank transfer, card payment, or check, depending on the payment method. The key idea is that payment happens immediately or at the time of the transaction. For example, if a business sells goods for 3,000 Ghana cedis and the customer pays immediately by mobile money, cash or mobile money increases and sales revenue increases. Credit transactions. A credit transaction is a transaction where payment is not made immediately. Instead, the business either owes someone or someone owes the business. A credit sale happens when the business sells goods or services to a customer, but the customer will pay later. This creates accounts receivable. A credit purchase happens when the business buys goods or services from a supplier, but will pay later. This creates accounts payable. Cash versus credit transactions. In a cash transaction, payment happens immediately. In a credit transaction, payment happens later. If a customer buys goods and pays immediately, it is a cash sale. If a customer buys goods and promises to pay later, it is a credit sale. If the business buys goods and pays immediately, it is a cash purchase. If the business buys goods and agrees to pay later, it is a credit purchase. A credit transaction is still a transaction and must be recorded even if cash has not moved yet. Real businesses provide many examples. A retail shop may buy inventory for cash or on credit. A service business may receive payment immediately or allow the client pay later. A restaurant may buy ingredients for cash, and an unpaid electricity bill is still a transaction because the expense has been incurred and the business now owes the utility provider. In construction, signing a contract alone may not always be enough to record revenue immediately. We must look carefully at what has actually happened financially. Majesty Nuts Cashew transaction examples. Imagine Majesty Nuts Cashew buys raw cashew nuts for 5,000 Ghana cedis and pays immediately. That is a cash transaction because inventory increases and cash decreases. If the business buys packaging materials worth 2,000 Ghana cedis on credit, inventory increases and accounts payable increases. If it sells 100 packs for 3,000 Ghana cedis and receives cash immediately, cash increases and sales revenue increases. If it sells 50 packs to a supermarket on credit for 1,500 Ghana cedis, accounts receivable increases and sales revenue increases. Cash and credit transactions both need recording. How to see transactions. The goal of this lesson is to help you develop the ability to see transactions. Whenever you read or observe a business event, ask, did something happen? Does it affect the business financially? Can it be measured in money? Is there evidence? And was payment immediate or delayed? These questions will help you identify transactions clearly. Before you record anything, understand what happened. Common beginner mistakes. Common beginner mistakes include recording business discussions as transactions, ignoring credit transactions, failing to keep source documents, mixing personal and business transactions, and thinking cash received means profit. Receiving cash from a loan is not revenue because it creates a liability. Owner investment is not sales income because it is capital. Always ask what kind of transaction occurred. Let us test our understanding. For each situation, decide whether it is a business transaction or not. A customer asks for the price of a product. 2. A business sells goods for 2,000 Ghana cedis cash. 3. A supplier sends a price quotation to the business. 4. A business buys office furniture for 4,000 Ghana cedis and pays by bank transfer. 5. A business receives an electricity bill of 2,000 Ghana cedis. 6. A business owner plans to open a second branch next year. 7. A business supplies goods worth 5,000 Ghana cedis to a customer on credit. Pause the video and try first before we discuss the answers. Let us now look at the answers to the practice activity. The customer inquiry is not a business transaction because no sale has happened yet. A cash sale is a transaction because sales revenue and cash increase. A supplier quotation is not a transaction by itself. Buying office furniture and paying by bank transfer is a transaction because furniture increases and bank decreases. Receiving an electricity bill is a transaction because the expense has been incurred. Planning to open a second branch next year is not a transaction because no financial event has occurred. Supplying goods worth 5,000 to a customer who will pay next month is a credit sale, and it is a business transaction. Simple memory guide. A simple memory guide is FMS. F means financial effect. M means measurable in money. S means supported by source document. A business transaction must usually be financial, measurable, and supported by evidence. If an event has these three features, it is likely an accounting transaction. Let us recap what we have learned. A business transaction is an event that affects the financial position of a business and can be measured in money. Accounting begins with identifying transactions. Not every business activity is a transaction. Source documents provide evidence that transactions occurred. Cash transactions involve immediate payment. Credit transactions involve payment later. A transaction can happen even when cash has not moved yet. Students must identify transactions before journal entries, and business owners must understand transactions because accurate financial reports begin with accurate records. Now that you understand what a business transaction is, you are ready for the next important lesson. We learned how to identify events that should be recorded, that source documents support transactions, and that transactions must be cash or credit transactions. In the next lesson, we will discuss understanding the chart of accounts. This will help us answer the next big question. Once we identify a transaction, where does it go? See you in the next lesson.